You're listening to certified financial planner Doug Goldstein, host of the Goldstein on Gelt Show, www.goldsteinongelt.com.
Okay, I'm very excited to have on the Goldstein on Gelt Show Bob Hoye, who is the Chief Investment Strategist at institutionaladvisors.com. They produce research that's specifically designed for professional investors like chief investment officers at funds and at investment companies. And one of the things that Bob has looked for in many times in the past, and we're going to talk specifically about today, is when the market is really blowing up like a bubble and perhaps getting ready to burst. So, Bob, I got to ask you, there's a lot of talk about the market being a bubble today. Is that just talk, or should we not worry about it so much?
Oh, yeah, it is a real financial bubble, and the features are reckless buying. The authorities, such as the central bankers, may try and talk wise, but they're really part of the bubble. They don't want to see this end. And there's a time feature. Well, there's two features in a financial mania. One is the intensity of speculation, and we have some technical tools, research that has been proven over the last 20 years to be very good in these circumstances. And we are getting signals which relate to momentum, and that's how fast the markets are going up. And then the other relates to pattern as to actually what the ups and downs recently are doing. And this is, let's use the term, Doug, ending action. And as to when it will end, where we're talking now, we've got lots of room here because we had a target. Well, we had a good buy signal in early November the 3rd, and the markets were down then. There was confusion about the American election. And then we had another buy signal in April. Now, this is getting close to the season when highly excited markets can conclude, and that season is around June.
When you say the season, there's a phrase that people often talk about on Wall Street. They say, maybe you can correct me because I often get the poem wrong. They say, sell in May and go away. Is that
that is the old saying, and where it works is when you have really excited trading going into it. And the other one...
Sorry, I want to get the definition. When you say excited trading, do you mean that there's more volume, more people are buying and selling, or are you just talking about the man in the street is now feeling like he's missing the boat, so he better start buying stocks?
The latter, yeah. The public hasn't really participated in the U.S. market for some time, probably not since 2007, which was a major high.
You mean participate as individual stock buyers? I mean, I thought people are putting billions of dollars into mutual funds and index funds.
Oh, they have been. But this is very intense speculation. And as I said, we have some technical ways that have been reliable. Maybe, Doug, we could put it this way. Our technical signals we're getting now, you only see at or near stock market highs, cyclical highs. Now, here's another one from history.
Before we go to the next one, let me just understand. When you say we're near a cyclical high, it actually makes it sound like, so we're at a high and it's cyclical. So maybe it'll go down, but then it comes back up again. For people who are long-term investors, can they just not worry about it?
No, not this one. There's a number of traps out there. The stock market gets most of the attention in a great bull market. It's just, all the media get onto it and everything else. But beside, and even a bigger market is the bond market, from shorter maturities out to longer maturities on high grade bonds, and then also for low grade bonds. And
the problem with the bond market, just to clarify, the people who normally would buy bonds would be people who are looking for more safety than the stock market. And because they've been buying these bonds, that's been pushing the price up, presumably. And now it's topped out, you're warning us?
Yeah, it has been, in aggregate, the biggest bond bubble in history. And in Europe, it wasn't just investors buying the market. You had the major central bankers buying the European bond market extremely aggressively. So you've never, ever had, in all of the history of interest rates down to zero, and in some cases at minus. So you look at it and you say, well, it was the Euro central bank policy and that's what they were using. But one should look at it in the perspective of a massive speculation, not just the fund managers that have been buying bonds or the individuals that have been buying bonds, but the central bankers are
Yeah,
on
let me clarify this a little bit
uh,
more. We see a lot of people. Obviously, if the price of bonds has been going up, there have been a lot of buyers. This is what we've been hearing so far today from Bob Hoye, who's the chief investment strategist at institutionaladvisors.com. Bob, let me clarify. If people are buying bonds and pushing, and I'm talking about normal people, right? You got a retiree and he doesn't want to be in the stock market anymore for any of a number of reasons. He's got to put his money somewhere. So he says, I'm going to buy some bonds and I'm going to collect the interest and, the bond values will go up and down. Is that the guy who has to worry if he's going to hold the bonds to maturity?
Yes, what one can do and particularly now, the corporate bonds in Europe and in North America have been bid to, well, the yields are exceptionally low, bond prices are exceptionally high. What can happen here is that it's not going to be a policy move to raise interest rates that would break the market. It's more the discovery that the corporations that have been issuing bonds and countries that have been issuing bonds may not have the ability to service the debt. As you know, interest has to be paid, bonds have to be redeemed. So it won't, and nor will it be a sudden big burst of inflation as commodities soar. It's quite likely the discovery that the people who have been borrowing the money do not have the ability to repay it. So on the bigger
Well, it
picture,
seems that the rating agencies, if we're talking about reasonable rated bonds that you're buying, let's say from corporations, let alone from governments, they do have an income stream. It's not that they're borrowing money with no income stream to back it up. They have a business and they're selling products. And, there certainly are areas in the economy that's growing and earnings are growing. You would think that these companies, I'm not talking about the stocks, but at least at the very least, they would be able to pay back a loan that they make over the next couple of years. So I'm focusing on shorter term corporate bonds. I'm wondering if, people have to worry that these major companies that they're buying bonds from are simply going to default on the bonds.
yeah, well, there's two ways, Doug, looking at it. One is term risk. If you're too far out, you're holding 20-year bonds, the price can vary all over the place in the next few years. And the other is if you're in too low a grade bond, of course, it can have a financial problem. But what the problem is that when you get into a highly speculative market, the change to a contraction can take a few months. But in looking backwards at it, it happened pretty quickly. So the amount of bonds outstanding are, I would suggest, are way more than any corporation or the economy can service. And that's if you have a firm to steady economy. But when you go into a financial crisis, the economy contracts as well. Then, as you mentioned, you've got the credit rating agencies. And of course, sometimes they can be behind the markets, like in 2008. Their
Well, I'm kind of
ratings,
hoping they learned something from their mistakes there, and maybe they're a
well,
little bit more careful about how they rate things now,
yeah,
because they don't want to be, they don't want to be proven the fool again by giving a bond a good rating, and then it turns out that there's nothing behind it. Bob, and we're nearly done, but I want to leave people with a takeaway. Let's say, we've got a lot of people who are nearing retirement or retired listening to the show, and they're looking for a place to put their money that's going to give them some income because the banks pay zero. Normally, retirees go for bonds. What's the option that someone like this should consider? And obviously, I know you're not giving individual investment advice, but we're just here for an educational discussion.
oh, sure. On the term, you can buy investment grade corporate bonds, but instead of being out 20 years where you can have great term risk, you can come in and buy a 3 to 4 year good grade, an investment grade bond. And while the price can fluctuate somewhat, it won't be a huge fluctuation as you get in the longer maturity. So our ideal would be a good grade, investment grade corporate bond, 3 to 4 years maturity. And where possible, we would buy the American bonds because there's a probability that the US dollar, being the senior currency, could go up relative to most currencies. So you would then get security, you'd get some some income and you've minimized your risk. And plus, there could be a bonus from the appreciation of the U.S. dollar. I think it's a nice place to look at.
Okay, that gives us certainly a great place to start. I know that there's a lot more information, Bob, that you share with people. So in the last few seconds, just tell us, how can people follow you and follow your work?
Yeah, we can have the website with a long name, which is institutionaladvisors.com. Or actually, I've discovered, to my amazement, if you just Google my name, Bob Hoye, it all comes up just like that. So
amazing. You're famous on Google as well as on the Goldstein on Gelt show. Listen, it was a real pleasure talking. Thank you very much, Bob Hoye, for taking the time for us today.
Doug, good to be with you.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.